Before talking about RRSP, Registered Retirement Savings Plan, it's important to know what a registered account is first. A registered account is an investment account that's given tax-deferred or tax-sheltered status by the government. On the other hand, checking account, saving account are considered as a non-registered account. In order to ensure registered accounts are being used for its intent purposes, the government put rules in place that we must follow. RRSP is an example of registered account. It's not an investment. It's a type of account. There's no minimum age for opening an RRSP. You can also open as many as you want at financial institution as long as you follow the government rules. For my US audience, RRSP is similar in many ways to the IRA, the Investment Retirement Account. This is Sandy Gunt. In this episode of Real Money, Real Talk, I will be talking about how RRSP works and what you should know about RRSP. RRSP was introduced back in 1957 to promote savings for retirement by employees and self-employed people when the defined benefit pension plan were still common. RRSPs are individual plans, while pension plans are plans being established by the companies or governments to provide pensions to their employees. However, pension plans have been disappeared since 1957, and therefore Canadians are now largely on their own to save for retirement. RRSP is one of the great tools that's available for Canadians for mainly two things. It allows to defer tax and grow money tax-free. However, there's a limitation how much you can contribute to your RRSP. In 2020, the contribution will be limited to 18% of your 2019 earned income to max $27,230 plus any carry forward contribution room that you may have. Earned income includes your employment income from your T4, self-employment income, or commissions from your T4A, or any net rental income. If you are not too sure about your RRSP contribution room, you may find it on your latest assessment, which is your notice assessment, under the RRSP deduction limits statement by logging to my CRA account. I will be including the link under my description. In summary, anyone who has earned income, has a social insurance number, and has filed tax returns can contribute it to RRSP up until to the December 31st of the year that they turn age 71. If you continue to have an earned income after age 71, you can contribute it to Spousal RRSP up until the December 31st of the year that your spouse turns age 71. RRSP for the spousal can be also applied to common law as defined by the CRA Canada Revenue Agency. RRSP can be converted to RRIF, Registered Retirement Income Fund, at any time. However, RRSP must be either converted to annuity, to RIF, or paid out as a lump sum by the December 31st of the year you turn age 71. You're allowed to over-contribute to maximum $2,000 lifetime without incurring any penalties. The over-contributions, however, will not qualify as an income deduction towards that tax year. RRSP contribution that's more than the allowance will be penalized at the 1% rate per month on the overage amount as an over-contribution penalty. When you take money out of your RRSP, every single penny is taxable. when you make a withdrawal from your RRSP, you will be subjected to withhold tax by the financial institution. The amount of withholding tax will be based on the amount you withdraw. However, it's never more than 30% or 31% if it's in Quebec. Withholding tax is not a penalty. Remember, you have already deferred your income tax by depositing money into your RRSP. Now you're simply paying tax that you previously deferred to allow time for your investment to grow without taxation. There are two scenarios that you can take out money out of your RRSP without taxation, which I will be addressing them in my future episodes. So can you think of a situation where it could be applicable to you that you can utilize the RRSP vehicle to build wealth? Well, the whole concept of RRSP really is to contribute when your income is high and withdraw when income is low. As I mentioned before, RRSP is an account, it's not investment. So inside the account, you can actually put all different types of investment, such as bond, ETF, options, stocks, private equity products, or even real estate. The deadlines for an RRSP tax contribution is always 6 days after the end of previous year to be eligible for a deduction. For example, the deadline of contribution for 2019 earned income will be on March 2nd, 2020. There are 4 types of RRSP. We have discussed 2 types already, which is individual RRSP and spousal RRSP. There are 2 other types, which are group RRSP and pooled RRSP. Group RRSP basically is employers that arranges contributions, allowed employees to make those contributions. For pooled RRSP, where you basically enables individuals to participate in large pool pension plan. To recap what RRSP is, money is deposit pre-tax. The amount of contributions will be used towards tax deductions against your income for the year. Investment inside your RRSP will be growing tax-free basis, but tax will be paid upon withdrawal at the marginal tax rate. If you find this video helpful, please help me share. I hope you enjoyed this video and learn lots about RRSP. If you want to know more about finance and money, please click the button, subscribe my channel, and don't forget to turn on the bell. I will be releasing my video every Wednesday.